The ledger does not care about your emotions. It does not care about fear, panic, or excitement. The ledger simply records actions. It records who holds and who sells, and right now the ledger is recording something very interesting. While most people are focused on the red candles and the 30% price drop since January, something much bigger is quietly happening behind the scenes. Welcome back to We Are Cosmic, the channel where we break down crypto, finance, and the future of the digital economy in a simple and clear way so everyone can understand what is really happening in the market. Today's discussion is extremely important because what we are seeing right now might go down in history as the great XRP flush of 2026. Many investors are looking at the chart and feeling nervous. They see the price dropping, they see negative news headlines, and they start to believe that something is wrong with the asset. But experienced investors know that the market often works in the opposite way of public emotions. When fear is high, opportunity usually appears. So the real question is this: are we watching the collapse of an asset, or are we watching one of the biggest accumulation phases in crypto history? Because when we stop looking only at price and instead look directly at the blockchain data, we see a completely different story. Right now, the XRP ledger shows something powerful. Despite the price correction, the total number of XRP wallets has actually reached a new all-time high of 7.8 million wallets. Think about that for a moment. The price is down, but the number of participants is going up. That behavior is not what you see in a dying asset. In fact, it often happens during major distribution phases, where ownership spreads into more hands while weak holders exit the market. This creates a psychological trap. New investors look at the falling price and assume the market is collapsing, but professional investors look deeper. They analyze the divergence between market sentiment and blockchain reality. Sentiment right now says fear, but the ledger says expansion. What we are watching is a classic market transition. Smaller traders who rely heavily on emotions are leaving the market. Meanwhile, larger players with long-term strategies are quietly stepping in. This is how wealth transfers often happen in financial markets. The public sells during fear, and the patient buyers accumulate during uncertainty. To a beginner, the chart looks like failure. But to a strategist, the ledger looks like a heat map of opportunity, and this difference in perspective can completely change how someone experiences the market. Instead of reacting emotionally to every red candle, you start asking bigger questions. Who is buying? Who is leaving? And what does the data actually reveal? Right now, the answer appears clear. We are witnessing a shift in power. Retail investors who bought during excitement are slowly exiting, but the number of wallets continues to rise, showing that the asset itself is not disappearing. Instead, the ownership structure is evolving. This transition is happening across the entire crypto industry. For many years, crypto was mostly driven by speculation. Traders chased quick profits and price pumps, but today the industry is entering a new phase, the utility era. In this new era, digital assets are not just speculative tokens. They are becoming infrastructure for real financial systems. Payments, settlements, asset tokenization, and cross-border transfers are all moving on to blockchain networks. And assets like XRP are being positioned right in the center of that transformation. That is why the current moment is so important. While most people are focusing only on the short-term volatility, the foundation of the network is quietly growing stronger. So here is the key question I want you to think about as we continue this breakdown. Are you reacting to price, or are you studying the ledger? Because in the next part of this analysis, we are going to reveal something even more surprising. We will look at how major financial institutions may already be absorbing supply while retail investors panic sell. And if that data is correct, it means something very important. Now let's move deeper into what might be the most important development happening in the XRP ecosystem right now. Because while many retail investors are watching the price chart and reacting emotionally, a completely different game may be taking place behind the scenes. This is where we begin to see the difference between short-term traders and long-term strategists. Over the last 90 days, something interesting has been happening in the background of the market. Major financial institutions have started to position themselves more aggressively in the digital asset space. Some of the biggest names on Wall Street, including asset management giants like BlackRock and Grayscale, have been steadily expanding their involvement in crypto markets. These institutions do not think like retail investors. They are not chasing quick profits from daily price swings. Their strategy is built around long-term control of supply, and according to blockchain data, a large amount of XRP may already be moving away from public exchanges. When XRP sits on an exchange, it is considered liquid supply. That means anyone in the market can easily buy or sell it. But when those tokens are transferred into cold storage wallets or custodial accounts, something important happens. That supply effectively disappears from the open trading market. This is where the concept of the ETF vacuum effect comes into play. Over the past few months, analysts tracking on-chain data have noticed that hundreds of millions of XRP are gradually moving from public exchange wallets into institutional custody solutions. Some estimates suggest that more than 500 million XRP has been transferred into long-term storage wallets connected to institutional infrastructure. Now think about what that means. Retail investors might be selling during fear. But if institutions are absorbing those tokens and locking them away for long-term holdings, the circulating supply available for the public market starts shrinking. This creates the foundation for something called a supply shock. A supply shock occurs when demand for an asset increases, but the available supply becomes limited. When that happens, even a small increase in demand can cause large price movements. In simple terms, the market may look quiet today. But under the surface, the available inventory might slowly be disappearing. To understand this better, imagine a neighborhood where houses suddenly appear very cheap because few buyers are currently interested. Many homeowners start selling because they think the area is declining, but behind the scenes, powerful real estate developers are quietly purchasing those homes one by one. They are not planning to flip the houses immediately. Instead, they are accumulating the land itself, preparing for a future development project. At first glance, the neighborhood looks empty, but in reality, ownership is quietly shifting into the hands of powerful investors. This is a powerful analogy for what may be happening with XRP right now. Retail investors are focused on the silence. They see falling prices and assume that demand has disappeared. But the deeper blockchain data suggests that ownership may actually be consolidating into stronger hands. And this brings us to an important concept that most investors never think about. The crypto market is not just about price, it is about distribution of ownership. When weak hands exit the market and stronger hands accumulate supply, the structure of the network begins to change. The people who hold the asset start to matter more than the daily price itself, because those holders determine how much supply remains available in the market. This is why institutional accumulation can be so powerful. Institutions typically hold assets for years, not days. They are not trying to catch short-term pumps. They are positioning themselves for long-term financial infrastructure. And this leads to a very important question. If institutions are absorbing supply today while the public is selling, what happens when global demand for blockchain payment systems begins to accelerate? Because if the supply has already been locked away, the market could face a situation where new buyers are competing for a much smaller pool of tokens, and that is when price discovery becomes explosive. But before we even talk about future price potential, there is something even more important to understand. Because most investors only focus on one number, price. They constantly ask questions like, will XRP reach $10? Will XRP reach 100? Is the next bull run coming soon? But professional investors look at a completely different metric. They look at network ownership. Instead of asking how high the price might go, they ask a much more strategic question. What percentage of the network do I control? This shift in thinking changes everything, because once you start thinking in terms of ownership percentage instead of just price speculation, you begin to understand where you truly stand in the ecosystem. Right now, the XRP ledger gives us a fascinating insight into this. As of March 2026, the data suggests that holding approximately 2,232 XRP places a wallet inside the top 10% of all XRP holders in the world. Let's pause and really think about that. There are currently about 7.8 million XRP wallets on the ledger. If you hold 2,232 XRP or more, you outrank roughly 90% of all participants in the entire network. That is a powerful statistic. And it becomes even more interesting when we compare it to the global population. The world currently has more than 8 billion people, but the total supply of XRP is capped at 100 billion tokens. A large portion of that supply is already locked in escrow, lost in inactive wallets, or held by long-term institutional holders. This means the amount of XRP that is truly available for the public market is much smaller than many people realize. Now let's talk about cost. At the current price range between roughly 135 and 145, accumulating 2,232 XRP would cost somewhere around $3,000 to $3,200. In other words, for the price of a high-end laptop or a used car, an investor can potentially position themselves within the top 10% of the global XRP ownership structure. That is a window of opportunity that may not remain open forever, because as institutional demand increases and supply continues moving into long-term custody, the price required to reach that same ownership level could increase dramatically. Think of it like buying land in a growing city. Early buyers are able to secure property while prices are still relatively low. But once development accelerates and demand increases, the same property becomes much more expensive. The exact same logic applies to digital asset ownership networks. Early participants can secure a larger percentage of the network before demand expands. Later participants must pay significantly more to achieve the same ownership level. And this is where the concept of the XRP rich list becomes extremely important. Every wallet on the XRP ledger holds a ranking. That ranking determines where that wallet stands compared to every other participant in the network. Most retail investors hold less than 500 XRP. This means the average wallet sits far below the 10% threshold. So when someone crosses the 2,232 XRP mark, they are no longer part of the average retail crowd. They move into a completely different category of participants. Instead of being a short-term trader reacting to price movements, they become a stakeholder in the network. And psychologically, this shift can be extremely powerful. You stop watching every price candle, you stop reacting emotionally to market volatility. Instead, you begin thinking long-term. You start asking questions like, how strong is the network growing? How many wallets are being added? How much supply is moving into long-term storage? Because once your goal becomes network position instead of quick profit, your entire investment strategy becomes more disciplined. This is why many experienced crypto investors focus on accumulation phases rather than market hype cycles. They know that when prices are suppressed, the barrier to entry is lower. In other words, the current market downturn might actually be the only reason the top 10% threshold is still reachable for average investors. If institutional demand continues to grow, that same entry level could eventually require 5 or even 10 times more capital. And that brings us to the next level of the discussion. Because while the top 10% club is already a powerful position inside the network, there is another tier that changes the game completely. Now that we have discussed the top 10% threshold, we need to cross into a much more exclusive territory. This is where the conversation shifts from normal retail participation to what can be considered high-level network ownership. Because while entering the top 10% of XRP holders is already a strong position, the real power inside any financial network usually sits with the top 1% of participants. This is the tier where serious influence begins. As of March 2026, blockchain data suggests that the entry barrier to join the top 1% of XRP holders is approximately 46,400 XRP. At first glance, that number might seem large, but when you compare it to the global scale of the network, it becomes extremely interesting. Remember, there are currently about 7.8 million XRP wallets in existence. Only a tiny fraction of those wallets hold enough XRP to reach this level. If someone controls around 46,400 XRP, they are already ahead of 99% of all wallets in the entire network. That is a remarkable level of ownership in a financial system that could eventually serve millions or even billions of users worldwide. What makes the current situation even more fascinating is that only a few months ago, the entry point for the top 1% was above 50,000 XRP. In other words, the recent market downturn has temporarily lowered the barrier. This is something many investors fail to recognize. During market corrections, over-leveraged traders are often forced to sell their positions. Fear spreads through the market, and weaker hands exit the ecosystem. But for disciplined investors who are thinking long-term, this process creates a rare window of opportunity. While the outside world sees a falling price, the strategist sees network consolidation. Tokens are moving from short-term traders into the hands of long-term holders who are quietly strengthening their position. In fact, data from wallet distribution suggests that the 10,000 to 50,000 XRP wallet category has been growing during the downturn. This indicates that a group of investors is actively climbing the ownership ladder while others are leaving the market. This is exactly how wealth concentration forms in most financial systems. During periods of fear, patient investors accumulate assets while the majority focuses only on short-term price action. Now let's talk about what reaching the top 1% actually represents. When someone holds around 46,400 XRP, they are no longer just a participant in the network. They become a significant stakeholder. At this level, the daily price chart becomes less important. Instead of focusing on hourly volatility, these holders begin to watch structural trends such as supply distribution, institutional adoption, and global payment integration. This is because the long-term value of an asset like XRP is not determined by short-term speculation. It is determined by utility. The vision behind XRP has always been connected to global payments and the concept of the Internet of Value, where money moves across borders as easily as information moves across the Internet today. If that infrastructure continues to develop, then owning a meaningful share of the network becomes far more important than timing the perfect entry price. And this is where we see a major shift happening in the crypto industry. In the early years, most people treated digital assets like speculative chips in a casino. But today, large financial institutions are beginning to integrate blockchain technology directly into their operations. By 2026, digital assets are increasingly appearing on the balance sheets of major corporations, and blockchain-based settlement systems are slowly becoming part of the global financial infrastructure. If that trend continues, then the competition to own portions of these networks could become extremely intense. And that leads to a critical reality. The circulating supply available on public exchanges is not infinite. If large institutional buyers continue accumulating XRP and moving it into long-term custody, the number of tokens available for retail investors to reach the top 1% tier could begin shrinking rapidly. In other words, the ladder that allows investors to climb into the top ownership levels may not stay open forever. But here's where the story becomes even more interesting. Because institutions are not always buying assets in a way that is easy to detect. Now that we understand the thresholds for the top 10% and the top 1% of XRP holders, it's time to talk about something most investors completely miss: the role of ghost wallets and institutional accumulation. Because while the retail crowd is busy watching exchange balances and price charts, the real movers in the market are often invisible. These invisible wallets are called ghost wallets, and they are owned or controlled by institutions like ETFs, custodians, and large financial players. Ghost wallets are different from regular wallets because they aren't actively traded on exchanges. Tokens sitting in these addresses are effectively removed from the liquid market. They do not contribute to daily trading volumes, yet they influence the supply dynamics in a very powerful way. Here's the simple truth: most people are looking at the wrong numbers. They track exchange balances to guess where the market is headed, but that strategy is outdated. Today, the most aggressive accumulation happens quietly behind the scenes. The evidence is clear. Over the past several months, we've seen a significant increase in mid-tier custodial wallets holding between 10,000 and 50,000 XRP. This suggests that institutional players are distributing their holdings across multiple accounts to remain under the radar. Why does this matter? Because it creates a supply vacuum in the market. Tokens leave exchanges and enter cold storage. As this happens, the number of XRP tokens available for everyday buyers shrinks, and a shrinking supply in the presence of growing demand is the perfect formula for a supply shock. To put it simply, while retail traders panic sell, institutions are quietly locking away XRP, positioning themselves for the next phase of price discovery. Now let's tie this back to strategy. If you're aiming to reach the top 10% or eventually the top 1%, you need to understand how supply is moving. Ignoring ghost wallets means ignoring the real market forces. This is why professional investors use on-chain analytics and dashboards to track custodial flows in real time. It's also important to note that this accumulation is not short-term speculation. Institutional wallets are built for long-term holdings. They don't care about stop-loss orders, short-term swings, or headlines. Their goal is network influence and positioning for utility adoption. And here's another crucial factor: the Clarity Act in the US. This legislation could classify XRP as a non-security commodity, giving institutions much more confidence to invest. But any delay or opposition in passing the act could slow down the institutional floodgates. creating policy-driven uncertainty in the market. For retail investors, understanding these institutional shadows is critical. It changes your perspective from reacting to price to analyzing structural supply shifts. You start to see the difference between temporary volatility and permanent redistribution of wealth. This is why staying informed and disciplined matters more than ever. Tools like XRP Scan and other on-chain trackers can help you monitor escrow releases, ETF inflows, and ghost wallet movements. By following these patterns, you can anticipate supply shocks before they hit the headlines or price charts. And this brings us to the final piece of the puzzle, your personal strategy to navigate this market. Simply watching the market isn't enough. You need a structured plan to accumulate XRP efficiently, take advantage of the temporary low prices, and secure your position in the network before the supply ladder disappears. Now that we've explored ledger data, institutional accumulation, ghost wallets, and network tiers, it's time to turn all that insight into actionable steps. This is where knowledge becomes strategy, your 30-day execution plan for navigating the XRP market in March 2026. The first principle is simple. Don't chase the bottom. Many retail investors wait for the perfect price and miss opportunities while fear keeps them on the sidelines. Instead, disciplined accumulation works much better. A practical approach is to dollar cost average, DCA. For example, acquiring 100 XRP per week spreads your purchases over time, lowering your average entry cost and reducing emotional mistakes. Your first target is the top 10% benchmark of 2,232 XRP. Reaching this milestone positions you in a network tier above most retail wallets. For most investors, this is achievable with current prices, but the window won't stay open long. As institutions continue locking up supply, the cost to reach this level could rise dramatically. Once you hit the 2,232 XRP base, your next strategic buffer is 5,000 XRP. This is a protective step, creating a cushion against future price-driven barriers. Think of it like building a safety net. Securing this buffer ensures that even as ETFs lock more supply and the network scarcity increases, you maintain your relative rank in the system. Finally, for those with the capital and conviction to reach the top 1% threshold of 46,400 XRP, the principle is the same. Disciplined accumulation, focus on network position, and long-term vision. Achieving this tier places you alongside the institutional whales and major custodial holders. Here, the stakes are high, but so is the potential influence over the network. Security is another critical component of your execution plan. Exchange redundancy is essential. Do not hold your entire position on a single platform. Use multiple trusted exchanges like Kraken to ensure you can access your XRP at any time and reduce exposure to exchange-specific risks. This is the foundation of protecting your agency in the market. Tracking your percentile rank in the XRP rich list should replace obsessive hourly price checks. This shift in focus from price to network influence changes your psychology. You start thinking strategically about long-term positioning rather than short-term speculation. Institutional accumulation continues to accelerate the supply scarcity. Tokens are being locked away in custodial wallets, ETFs, and cold storage for years, not days. Monitoring these movements is essential. The data shows that liquid supply is shrinking faster than most people realize. If you are disciplined now, you can front-run this structural supply shift and enter elite tiers before public awareness catches up. Finally, consider legislative and regulatory developments such as the Clarity Act. Policy changes can impact liquidity, but a strong accumulation strategy is designed to weather both temporary delays and sudden institutional surges. By combining DCA, network position tracking, and supply awareness, you are prepared for multiple scenarios,